All right, it's another sloppy session. It's giving some credence to those who have been warning that September could be harsh, particularly in the first year of a new president. But should you follow the crowd or maybe be buying this weakness? I want to bring in Market Gates Group, Michelle Schneider, along with PPAC Private Wealth Management's David Dietz. And Michelle, how much of this weakness is sort of seasonal, or how much is just a mounting of all these concerns that seem to be mounting and mounting?
Well, in terms of seasonality, I was thinking about the autumn of our years, and this could be the autumn of the bull market. I mean, certainly that's possible since we've been going up for so long. But there have been some real issues. Certainly we know the variant is one, GDP growth is another, labor market as being another, and of course inflation, add that to the mix. But I do believe we're in a trading range, and I believe partly that trading range, which we're coming towards the bottom of, maybe we have one more leg down, is because on top of all of this, yields are still low, junk bonds are still high, the Fed is not going anywhere, and that's why growth stocks in particular are going sideways while we're seeing some of those internals that you and I have talked about a lot. Retail, transportation, manufacturing, industrials, kind of testing those lower areas. So at this point, I'm not too nervous about it, but we'll see. If we can't hold key here, IWM in particular, the 50-day moving average, maybe one more leg, but I'd be a buyer down there.
All right. The autumn of our growth, that might have been a Frank Sinatra B-side hit somewhere down the road. David, I saw your notes. The market hasn't had a 5% pullback. You noticed that. You don't think we're going to make it through the rest of the year without that happening, right?
Well, I'm the last one to tell my clients to try and time a 5% pullback. But if that were to happen, no one on Wall Street would tell you they're surprised. We've got background conditions that have been plaguing us all year long. Some of the highest valuations on record. You've got speculative activity with the cryptos, the SPACs, the meme stocks. You've got the participation in the individual investor. I love that, but it echoes that shoe shine boy from the 1920s. And of course, in some ways, we are worse positioned here at the end of the summer than they were at the beginning. We didn't see this Delta variant becoming as virulent as it has. We are closer to monetary tightening than they were at the start of the summer. And of course, the supplemental job assistance, that's ended. And so I think there's a lot of reasons why this market could take a pause, if not pull back 5%.
Let me pick up on the crypto thing with you, Michelle. Obviously, Bitcoin all over the place. I think if I read your notes right in some of your tweets, you like Bitcoin on weakness, though, as a buy, don't you?
I do. I think that if you look at what happened, first of all, it was very highly leveraged, so the flash crash of yesterday was not completely unexpected after a long weekend. The El Salvador news might have been a little bit anticlimactic, and of course Gensler and the IMF coming out with the threat of regulation. But overall, and I think this is probably the most interesting thing I've read so far, is that Michael Saylor bought 300 Bitcoins in this dip, and we have whale buying. El Salvador only owns 400 Bitcoin. So think about that. You still have a tremendous institutional investment here, and I still think we're going to go higher, and this is probably a little bit dust settling by opportunity.
You like China on weakness, David. We're running out of time, but tell us the best of viewers, the best way to take advantage of this, the weakness in China.
We would go diversified. We like this iShares China Large Cap ETF. It's down about 30% since February. Many of the components are trading at a fraction of the valuation of what their U.S. counterparts are. I would throw as an example of a component, DD, which is the ride-hailing service. By some measures, it's just 1/6 in terms of the valuation relative to Uber or Lyft. That's a bargain to me.
All right. Hey, GameStop reporting after the close. The street's looking for $1.12 billion, a loss of 67 cents. We know, though, that's not what's going to move the stock. Michelle, what are you looking for?
Well, I think either a dip to 180 or over 217 would probably be the buy. We're in the chop zone here. But as we know, fundamentals could improve down the road, not going to affect this quarter. I would not say that this is a stock that's been moving fundamentally up to this point. So I'm not expecting anything too horrible or too surprising.
Technically, though, if it got above 210, would that be a buy?
I like it a little bit over that. 217 is really my number because that clears a 6-month calendar range high.
All right. Hey, Michelle, David, thank you both very much. Always appreciate it. By the way,